Good morning, ladies and gentlemen. Well, the risk dial is at minus 34 by my calculations. The good news is that we've started to rewrite all the code for the website so it works properly. It's going to take about 6 weeks, but then we will have something much better and cover a whole load of tickers and symbols that we haven't been able to cover so far. That having been said, let's have a look at what the bonds are saying. And the bonds are saying that we are in for a very volatile time. The 2s, 10s have basically reached every single one of my target and exceeded it. And now, the real support is where we haven't been any lower than, which is 0. And it looks like the curve is very much inverting, basically saying that we are going to go into recession at some stage. This is a very worrying chart. And combined with the steepening of the 530s that I will show you in a moment, basically says that the bond market is really afraid of a stagflation situation where the economy is in recession and very high inflation persists. Here we have the 530s first in a weekly format. And you can see the slight steepening that we're having at the moment. That basically is indicating that people are not touching the 30s as much as they are worried about the short term, and they're basically buying more 5s. Whatever chart I look at, we are basically getting to, we could easily come back down to 80 and not have too much difficulty still. You can see how, when the market is uncertain, the 530s just go berserk. And that is what we could see next week as well, all depending on how, what the war news is and what the market ascertains is the most likely outcome. I think it'll remain volatile. I think we could easily see one of these, and that would mean that we see a lot of volatility in all assets. The most volatility will be seen in Europe for obvious reasons. Europe is by far the most affected region of the world by the turmoil in Russia, Ukraine. And here we have the 2s straight back, to minus 75, minus 77. This area basically is saying that if we go through, they're looking for the central bank to ease conditions and that we are definitely going into recession. Everybody is in the short end of Germany. If we have a look at what the 5s are saying, this is the bubble. It stopped right in the region that I thought it would stop, which is this minus 31 to minus 40 region, but now we could easily fall back down to the bottom of minus 62. If the market does not think that there is going to be a solution in the short term, that is what the market will do. It'll inflict maximum pain on everyone. That is why I did absolutely nothing last week, and that is why I think one should do absolutely nothing until the situation is resolved. The likelihood of a fall down to these minus 60 area is just as high as a resolution and a move back up to the highs, really. Inflation is here to stay. The only thing is recession is going to be more powerful for for the bond markets. And yes, the risk off move swamps everything. The first risk off move is probably the wrong thing, but it still happens and it stops everyone out. I cannot exclude a move down to minus 60s, and I think it's quite probable if there is no resolution in the conflict. At some stage, things get worse, and what you have to decide is what is the likelihood of things getting worse. I think the likelihood is very high. I think this is an existential problem for Russia, and I think that they will escalate before they de-escalate. So the likelihood of a breakdown is very, very high. If we look at what the bunds are doing, and this is the 10-year, we could easily get a move down to here, which is minus 45. The yield curve will probably both steepen and flatten at some stage, but I think, you know, the likelihood of a move which just swamps everything, a panic move, is quite high. And therefore you just cannot position with any certainty, because whatever you do, you're likely to get stopped out on headline news. But I would have thought really the likelihood is that we break lower unless there is a headline news of peace. And why? The France chart has been really the most accurate. As soon as we broke this level, we never retested it. Now we could easily do an ABC all the way down to the 20s. And that tells me that the bunds are, you know, if we go back to the bunds, we could easily get an ABC all the way down to minus 39 level here. It's the risk off move. It swamps everything. It doesn't have to make sense. It just happens. The 5-year note, notice the similarities between here and now. Support 145. Can one exclude a move all the way to 116? Absolutely not. Have a look. We are basically in this range. We are in this range between 116 and 177. This is again, you know, what I've been saying about the curve in the 530s. It could really get very volatile, and we could have moves all the way down to 116. I would have thought that that is a much better buy in terms of yields than sell. And that is the risk reward area here at 116. But it's almost certain that we see 145. If we go to the 10s, this is, you know, less volatile, but really we could easily get a move down to this 139 area. And first of all, really on the dailies, the place to look for something is 151. That is where we could easily go. You know, it could easily trade down there to 151. The risk off moves just swamp everything. You don't have to think about logic. You don't have to think about the long term. It just happens because there are you know, no offers in paper. People are holding on to it, and this is what can easily happen. And that is why I keep on telling you, do not do anything but in options. We could easily see this move down. 30s are the ones that are going to be most stable. And basically, if we have a look at the weekly chart, I would have thought the odds of going through 190 are very low, and we're now 215. If we enlarge this chart, you know, basically you can see that we are stopping at this 200 week moving average, which is still pointing down. So I would have thought a 190 trade is about all we're gonna get, but still it just shows you that it's a risk off environment. and really the likelihood of the people being so afraid of inflation that they start selling bonds, I think it's very low for the time being. That is a medium term thing, a long term thing. These first moves are panic moves, are risk off moves that at some stage we get to take advantage of. I just don't think that that stage is next week. The dollar has basically reached the first target, which was 98.54. Can it easily get to 139 on headline news? Yes. What should you be doing here? I think here you should be buying long-term straddles, because really you are looking at moves that will either take out these highs that we have all the way to the highest high, which is here around 103, or at some stage there is resolution and we go back down. I don't think there will be resolution in the short term. As I keep on saying, you have to decide whether the Russians have decided that this is an existential threat to them. And I think that that is what it is. And therefore, the escalation of this conflict is, in the end, much more likely than a peace agreement in the next week. You have to be prepared for both, but you have to decide what the odds favor. Could there be some kind of could the Ukrainians say, okay, we will be neutral, withdraw your troops? Yes, they could. How likely is that? I don't think it's very likely. Not with the US basically goading them on and encouraging them. Therefore, I think the path of least resistance and where spikes could happen is to the upside. And therefore, I think that the likelihood that we see these highs at some stage around 103 in the next few weeks are probably higher than we don't. If we switch this to a euro chart, here we are. We reached my target and went through it. And really, the next low that we have to look for is around here, this 106 area. So you can see that basically, sorry, that's 107-ish, isn't it? And with the lows being around 106.37, could we see that? Yes. I don't think Bollinger Bands really mean that much in this situation. It's a headline-driven thing. You just have to know that on a really bad headline, you're going down to 106, and that's all there is to it. What can one say about gold, but that it will trade all of these levels most probably. The next level is 2045. On a bad headline, it gets there in no time at all. Peace, and as unlikely as it is, 1830 definitely trades, and probably 1764 again. But the likelihood is that we go to 2045 and then break higher. It's inflation, I think, is here to stay, unfortunately. And I think that gold is really the preferred way of people to hedge themselves. And it's unlikely that they are just going to dump it because the likelihood of peace prevailing is very, very low, I think, at the moment. If the headline comes out, peace in our time, 1881 is your next stop. But I think until it does, the market will be pushing for 2045. DBC made an absolute fool of me last week. And, I was so happy to get out at 24.39 from the longs that I've had. all the way from the break here, and poof, it just goes straight through. And really, what is the target? The target seems to be 29.73. And that is why I think the yield curve will continue to steepen. You will have the people buying the fives because inflation, and the fives will go up a lot more than the 30s because people will be looking for longer term inflation continuations. If we get up to here, well, it's not a disaster because don't forget we were here in 2011, 2012. So it's not showing that inflation is just the end of the world, but it's just showing you the mood of the market, and how much, how much deflation was priced in and how much inflation we can price in now. The interesting thing really is the chart against DBC against gold, and it's coming into areas where gold is going to be a better buy than DBC. What is that going to say? Well, that could be two things, i.e. that DBC turns around on a dime and falls much faster than gold. But in any case, it's going to be a level where it will show that it's much safer to be in gold than in DBC in terms of risk reward. We're very close to it. What's that? A couple of percentage points. That is going to be a signal in itself, and it's going to be very, very interesting to see the market developments where that is touched. My guess, and this is only a guess, is that gold is then going to be much more stable than DBC or accelerate much faster than DBC. And that will be a signal that we will follow closely on a day-by-day basis because it's going to be probably very profitable over the course of the next 6 months. I wanted to show you a chart of DBA as well, which has a lot of fertilizer companies in it and wheat and, basically agricultural, John Deere and stuff like that. It's an interesting chart from the point of view that it could be taking over from DBC. And I want to show you what happened. This is a weekly chart, don't forget. And I want to show you what happened back in 2007. From 2470, it basically exploded and doubled. This is something that could easily happen again as we have come out of a multi-year slump in DBA. The problem with DBA is that it has it loses a lot of carry because it's constantly long of wheat, which is trading at contango, and it keeps on losing money, as it were, as the carry is negative. So the fact that it's really, I would say that if it starts breaking 2250, it will definitely trade 2470. But if it starts breaking 2470, you have to look at charts of fertilizer. You have to start looking at charts of wheat, of soybeans and stuff like that, because it's likely to just explode. And given the situation with Ukraine and given the situation with Russia, and Belarus, if they start basically banning exports of fertilizer and stuff like that, you could easily see a 20-30% move in a few weeks, just like you did here and just like you did back in here in 2007. This is a great possibility because what happens with DBA is that the fertilizer component takes over from the commodity component, the agricultural commodity component, and from a backwardation it goes into into a very steep curve, and you get very, very steep moves. So DBA is definitely something to keep an eye on for the next few weeks. Oil is just gone. This is, if you look at what happened last week, it just opened, and I thought that was it. I thought when we touched 98, 97, 77, that was it. We came back and did a doji, it just opened and went. What can one say? If we don't return below 111, 110.53 very quickly, the odds are that this is going to be a big continuation move and that we get into the 130s without any problem. And that is what is weighing on Europe. When we have a look next at what Europe is doing in terms of share prices, you have to bear this in mind. Energy is just going berserk. And the fact that the euro is falling also exacerbates the costs to German industry, to European industry in general. Plus the fact that we are probably going to be in recession in Europe within the next month or so. So really, you have to keep a lookout for what oil is doing. If we keep on just basically not closing below 110.53, I don't think that another 10% on that price is unlikely, and that just destroys European shares. This is actually a monthly chart now of oil, and basically you can see that we have the highest close here is 140. I just want you to have that in mind now that we've broken these levels around 110, how far and how fast it can get there. This is basically 2 months worth of trading before it reversed. And that is the big danger, and that is the danger that we absolutely slam Europe over the next few weeks and couple of months, simply because European companies will basically not be able to, there'll be huge inflation. And the question is, how much pricing power do they have against the Far East and so on? So the situation in Europe is very, very dangerous. This is ACWI over SPY, so basically the world against the S&Ps. New lows, it's basically going down. I'm just showing you this because the real money flows are basically abandoning the whole world and going into the US. This is the flight to safety. So even within the equity sector, and S&Ps were down, about 1%, 1.2% last week. What does it show? It shows that everything is going down against the S&Ps. And I think until the situation in Ukraine resolves itself, this is basically a continuation move. This is ITOT over governments, so the totality of the stock market against government bonds. And we're going nowhere, but we are in a big, big danger of a major risk-off move. And I've been telling you for a long time that the fate of bonds and stocks is tied together because of the Blue Angels that I've shown you so many times, and I'll show them again to you. The danger is for a major risk-off move. That is the danger. I don't think it's going to happen because the differential in yields between stocks and bonds is still in favor of stocks. And that is why I don't think it's going to happen now. But this chart tells me that there's a big danger that it starts happening. So, excuse me, The danger is that we have a major risk-off move at some stage. If this is the US, can you imagine how bad things are going to get somewhere else? Because the US is going to be the last market in terms of equity markets that gets hit. Everything else is getting hit already much, much harder than the States, and will probably continue to get hit much, much harder than the US. And here we have the Blue Angels, and the fact that the thing that is striking is still expectations of earnings are going up. These are positively sloped curves. So unless the bonds, go higher in yield, and I've just been telling you why I think that is unlikely, because there is this risk-off feel and mood. Really, what can we expect? The worst we can expect is we go down to the times 18 Blue Angel, and that is just over 4,100, 4,000, 4,100, whatever it happens to be, which is the previous spike low. Don't forget, these are closes on the red lines. And basically do something like we did here, when we went down to the times 18 and just kept on bouncing off it. So really, that is why the US is so insulated from the falls, much more so than Europe or EEM. And I'm going to show you those charts next. Now this is EEM, and it has finally broken the 4504 area, which is so important. Look how many times it's been the top and then resistance, and then when it breaks it goes a long way. What to look for? Well, basically you can see these gaps here, and really the gap is at 41.45, and the 0.618 retracement of the whole move from the COVID is here just at 40.82. So that's another, well, nearly 10% that this market can fall. So this is giving you the likelihood of the path of least resistance. What is this chart saying? This chart is saying that basically the dollar will keep on going up, commodities will keep on going up, and equities will be going down, with the most vulnerable being the weakest countries, the ones with least flight to safety flows, and that is EEM. This is the Nikkei, and basically it's broken the 26,195. Unless it very quickly regains it and and stays above it, I think there is absolutely no reason not to expect it to trade down here. With this is where the 200 weekly moving average is, and 24,050 is the highest close we had here, and this is several months of trading. As you can see, it's there is absolutely no reason not to expect it to trade down there. As I keep on saying, all the other markets are far more vulnerable than the US. I doubt the US is going to make many new lows, but you can see where the pressure is. The pressure is in the developing markets and in all the other markets apart from the US. And here you can see what's happening in Europe. What to say about these two charts that I showed you last week? SPY over EWG and SPY over FEZ. Basically, they've got nothing going for them. Energy is going berserk. The euro is melting. What can the ECB do? What difference does it really make to equities if bonds are at -10, -20, or -30? Really, because they can't go. Where can they go? So all the pressure is going to be on Europe. There's huge headline risk in being short of Europe because something good could come out of it, but I really doubt it. That I doubt that anything really good can happen in the short term. Any kind of retracement here, I think we will see new highs. And basically, I'm really pissed off that I didn't stick with this and that I took profits far too early. But there you go. That's trading. I think any kind of move back, unless it's a real important headline, is going to be negated at some stage, and you will see moves to new highs in this spread. When you need to see how bad things can get, zoom out. Okay, so this is the DAX. This is a monthly chart of the DAX. And you can see how important these levels here are, just around 11,900 to 12,000. How many times we've had support there. We have the monthly Bollinger Band just below it, and we have the 50% retracement of the whole move up. Can it rally? Can it rally to whatever, 13.7? Yeah. But I think at some stage, unless the headlines are wowee, peace in our time and all that, I think you will ultimately see those levels and quite possibly a 0.618 retracement as well, which is 11,000, and quite possibly all the way into single digits. That's not single digits, 4 digits, I'm sorry, these kinds of levels. Why do I think that? Because you have to understand what the geopolitical situation is like. I believe that the Russians have decided that Ukraine is an existential threat, and therefore they will not stop. It doesn't matter whether there are sanctions, this or that, they will escalate and escalate and escalate until basically the situation is resolved in their favor. It's that or die, I think they've decided. If I'm wrong, I'm wrong, but that is my preferred geopolitical answer. That the Russians will go as far as they need to go to achieve a result, and whether that means that they flatten Ukraine completely and kill every single last Ukrainian, I think that is the way that we'll go. If that is what is necessary, they will do it. I hope that is not what happens, but I fear that is what they have decided, and that they will escalate and escalate and escalate, and that and therefore that the commodity situation will get worse, the agricultural situation will get worse, the dollar situation will get worse, the gold situation will get worse, and any rally here will just be met by a wall of selling that takes it to these levels. I hope I'm wrong, but I fear that I'm not. And therefore, you can see that is the path of least resistance, barring the Russians changing their mind, which is always possible, is going to be down. Okay, that is the longer term view. What about next week? Well, all the targets from the retracement down have been met, so it's quite possible that we have a rally in Europe. The rally will, I doubt, but apart from headlines which indicate that the war is over, I doubt we get higher than this level, 3,844, and probably, we've just failed to touch it. I think that will be a wonderful place to buy puts, because I think we will trade in this area here. If not next week, then the week after or the week after that, and that will be between 3,000 and 3,300. Percentage points are going to mean nothing in this kind of market if things turn ugly. It's going to be a real shit show. And therefore, those are the levels that you're looking at. I will definitely, at 3,844, I will be looking to buy puts, 2-month puts, 3-month puts, looking for a trade in this area. What does that mean for the S&P? Well, I think it means very little. I think that we are unlikely to make major moves in the S&Ps simply because the flows are towards the S&Ps. All the Nikkei that gets sold, all the EM that gets sold, all the Europe that gets sold, a lot of it is going into SPY. And therefore, I would have thought a continuation trade in this weekly. But, notice that the Bollinger Bands are beginning to expand. I'm just not bullish for SPY. I'm just saying is the one that's likely to go down the least and up the most. And we will be probably in a holding pattern for the next 2 weeks, waiting for the Fed. Not that we don't know what the Fed's going to do, but that is just another reason not to be selling S&Ps, simply because people are going to be very unsure about what the Fed is going to say they're going to do next. And as I've showed you, the relationship between S&Ps and bonds is absolutely solid. It goes up and down a couple of percent, but at the end of the day, at the end of the month, it's really gone nowhere. And the fact that the S&Ps really last week, well, what did they do? I mean, they they basically closed very slightly down when everything else was getting hammered. I think that is a continuation. As If we get a rally in Europe next week, we will go up to this 43.95 area, maybe a little bit higher, stop out these people at 44.10, 15, but then we go straight back down. I don't think that we are going to be much higher in the S&Ps, but I don't think we're going to be much lower either. I think S&Ps are your flight to safety. This chart of the volatility difference between VIX and V-stocks basically says it all. That is where the fear is in Europe. That is where the consequences will be in Europe. What to say. I don't think we ever really got any lower than -9,950. This chart will get definition next week. We might see moves back out to -6 and so on, but then we'll have definition and we will know what the important ranges are. Eventually, I think we bust through to the downside again. Although I don't think much is going to happen in the S&Ps themselves over the next couple of weeks, closes in VIX over 30 are beginning to be a real worry because they are showing a shift in the volatility regime. It's getting dangerous, okay? That's all I have to say. I think basically that if we get a move of around 10 to 15% in Europe, another 10 to 15% at some stage, you will get a 4-5% move in the S&Ps. A 5% move is 200 points, and therefore you call it 300 points with the spike. So you're looking for the market to revisit its lows at some stage and maybe slightly lower. But, this is worrying because every time it closes above 30, it goes into the 40s at some stage and the high 40s, look at these spikes to around 50% vol. So that is the danger. The danger is that at some stage we get a very bad headline and we just go up there. So being long is only in the States, it's only on a spread basis to Europe. I think Europe is really going to suffer, and any kind of move back to those levels that I showed you on the stocks chart and the DAX chart is going to be a wonderful opportunity to load up with puts. I've updated all the levels. I think the likelihood is that the European bonds at some stage suffer a panic and they go much lower in yield. And that will be the opportunity, most probably, to get some longer term puts in futures. The only problem is the volatility is so damn high that it's so difficult to do. But in any case, these are the levels. I think all the action is going to be in Europe and European yields and European equities. The levels are all updated and I will tweet to you. And I think definitely, my stance is that things are going to get significantly worse before they get better. And therefore, that rallies on partial headlines or sort of hopium are opportunities to buy puts. Thank you very much indeed, and tweet you on Monday.